This house that you guys are looking at right behind me is the former house of late actor and comedian Robin Williams. And some of you guys mentioned that he used to live over here, so I looked it up. This is his old house, and I have the listing info, guys. So he actually bought this property back in 2008, right during the housing crash, right, for $4.05 million. And then when the home was to be sold, they actually listed it for sale for $7.25 million. And as you can see, many price reductions later, the house actually sold for $5.35 million back in 2020, the end of the year. So the home only really appreciated about $1.3 million in the span of, what, 11 years? That's not that great probably for an area like this that seems to be pretty fancy and high end, especially when you look at Redfin's evaluation. They estimate that the house today is worth about 6.3 right now. I'm not sure if that's actually the house that he died in. Maybe that's why the price was low. I have no idea, because apparently I was told that here in California they have to disclose when there was a death in the house. Anyways, I figured I'd show you guys that and start off the video with something interesting. So hopefully that'll soften the blow a little bit for all the surprise expenses that new home buyers are getting hit with right now. You know, I made a video the other day talking about how property taxes and insurance now are basically the cost of a mortgage and are probably your biggest expense as a homeowner these days. But I forgot a big one, guys, and I didn't really forget. I didn't really have the solid data to put into that video, but today I do. Besides property taxes and insurance, did you know that repairs is going to be another huge expense for you? In the second quarter of 2023, annual maintenance costs for a house reached an all-time high of about $6,500 per year compared to about $5,900 just a year ago. Here's why that's a big deal, guys. Because, you know, we've been talking a lot about these different mortgage programs that they're coming out with. You know, 1% down, Zillow's offering it to people, Rocket Mortgage is offering it all over the entire country right now. So there's all these pushes to get people into homes with relatively low money down, or no money down in some cases. If you're a VA loan buyer or you get a USDA loan, something like that, you don't have to pay anything to get into a house. Well, that's targeted at people that don't make a lot of money, okay? So if you're facing $6,500 per year in potential home repairs, are you gonna be able to come up with that money? Because by my math, that's an extra $541 per month, guys. That's a significant amount of money. And yeah, we're passing by the house again. We get a little bit of a close-up here. Just kind of went down the blocks. It's like a cul-de-sac here. So it is a beautiful house. But anyways, $541 per month on average to maintain your home with regular repairs and maintenance. The standard advice for a first-time home buyer is to make sure you have a significant cushion for surprise expenses. And they say that that cushion should be worth about 5% of the home's purchase price. Now let's just go with median home price right now, sitting around $430,000, okay? Let's do a little quick math on that. That's about $21,500 sitting on the sidelines for potential home repairs, okay? Do you have that? Well, my guess is probably not, because if you're somebody that's doing one of the 1% down payment programs or something like that, then you probably don't have the money. And this is the question that you need to be asking yourself right now. If I can't come up with a 3% or 5% down payment for the house, how am I gonna come up with $6,500 a year, an extra $541 a month on average, that's just the average, or have an additional 5% set aside, which is on average about $21,500 at closing. This is after you buy the house, guys. So meaning you have the down payment, you paid for your closing costs to buy the house, and then you still need to have $21,500 in the bank. My guess is that the amount of people that fit this criteria is almost nobody. And that's why I'm bringing this up, because it's a big deal. I mean, these numbers are facts. You know, it's a fact that it costs that much to maintain a home every year. Now, sure, if you're gonna buy a condo, you know, where all the maintenance is taken care of for you, you're probably not gonna be paying $6,500 a year. And I can attest to that because I live in a condo. We don't pay $6,500 a year to maintain the place, but we pay HOA fees that cover that instead. So one way or another, you're paying, right? It's just a matter of how you go about paying for it. So that's the problem, guys. If you don't have the budget in place to maintain a home, it doesn't matter that you got into it to begin with, because it's going to end up bringing you down. It's going to bring your finances down. So people that are going to be buying today need to make sure that their finances are in shape. Make sure you have that extra $500-600 a month that's going to go towards maintenance, because you're going to need it, as well as that extra emergency fund, guys. You know, people look at, oh, what's my monthly payment going to be when it comes to buying a house, and don't look much further than that. But when you look deeper, there's a lot more to actually look into and more things to consider than just how much your monthly payment's going to be, because the cost of ownership will be higher than that. And one of the things that's kind of tricking home buyers today into buying as well are not just these 1% down programs that look like a carrot on a stick, but also the mortgage rate buy downs. And I want to cover this a little bit more in detail today, because first of all, I have a little bit more information on this. One of my viewers sent me a comment in my video with Nick from Reventure Consulting, and he said that he has access to numbers at the #2 lender in USA, and more than 50% of all loans for the last 2 years have either been a VA loan, that's $0 down, FHA, 3.5% down, or 2-1 buy downs, which means that you get a lower interest rate for the first 2 years of the loan. And that's half of the loans at this lender. Now, I don't know which lender that is, but according to Freddie Mac data, the numbers are much lower than that by all the loans that are actually backed by Freddie Mac. So in June of 2023, according to them, 2.8% of 30-year fixed rate loans funded by Freddie Mac had temporary mortgage rate buy downs. And that's up from a year ago. At the peak in December of 2022, 7.6% of loans had a mortgage rate buy down. And they put together some interesting data for us to look at here and visualize. If you look at this map of the United States, it shows you all the states and what percentage of states have loans closing with mortgage rate buy downs. And the reason why this is important to take a look at is because they might not be as beneficial as once thought. Because a lot of people look at this as, well, this is a great incentive for me to get into the house because I'm going to have a lower payment for the first couple of years, and then by the third year I'm not going to worry about it. I'll be making more money by then. I'll figure out a way to come up with that extra money. And get this actually works. This is actually a real incentive that gets buyers off the sidelines. There was a survey of home builders, and they asked them what's the most effective way to get buyers into the transaction. The #1 answer cited today, 69% of home builders said mortgage rate buy downs. Only 22% of them said price cuts. Now, obviously, they're trying to protect their own interest there, because the last thing they want to do is lower the price, because this is what happens. When they lower the price on a home, rather than give you a mortgage rate buy down, people who are already under contract for higher prices tend to cancel. Once they find out that you're buying the house for $50,000 less than they are, they're not going to be happy, so they cancel the deal. Because immediately, if they were to close, they're going to have negative equity by quite a bit, guys. If they actually followed through the transaction and you bought the same exact house for $50,000 less than they did, now they're immediately $50,000 underwater in that home the day that they get the keys. Now, there's a home builder here in the Bay Area called Land C Builders, and according to their people, they're saying that about 75% of their buyers in the last 60 days chose mortgage rate buy downs in lieu of other incentives such as options, upgrades, or homeowners association dues credits. So people are choosing these buy downs because they're saving money on the monthly payment, guys. But it all might not be what it's cracked up to be. Here's a real life example of someone who actually did this, okay? There was a couple in Oakland, California, and they bought a house for $866,000, and they got a 2-1 buy down, which means for the first 2 years their mortgage rate would be lower. So the first year it's going to be 4.125%, the second year 5.125%, and then after that it's going to go up to the actual rate that it's going to be, which is 6.125%. I don't know when they closed and when they actually bought the house, but that's a pretty low rate given where they're at right now at 6.125%, even at the end of it. So over the first 2 years of owning this property, the buy down will save them $15,470 in interest payments. But there's a catch, and isn't there always one, right? And here's the catch. They got the seller to pay for the mortgage rate buy down, but in return, they had to pay a higher price for the property. So that's a problem, because now that puts you in a situation where you have all sorts of higher expenses because you chose to pay more for the property rather than get a better deal on the price. And I'll tell you what those problems are. Now here's a house in the neighborhood that just sold a few days ago, actually, for $2.7 million for a 3-bed, 2.5 bath. And the previous owner coincidentally also bought during the last housing bubble for $1.25 million in June of 2007. And ever since then, the property only went up in value about $1.5 million, which sounds like a lot, but for an area like this, I would say it isn't. And here's why. Because just look at the property tax bill alone, guys. The last bill that this person had was $19,000 a year. Imagine all the other carrying costs to maintain this property, like we were talking about earlier in the video. How much did it cost to really own this place over the years? I'd be willing to bet probably close to $1 million. So they really didn't make that much after closing costs and maintenance and taking care of a property like this after all these years. Now, even people at Core Logic are saying that this is a bad idea to get these mortgage rate buy downs, because here's the problem. Outside of a few extreme cases, this doesn't have a significant economic effect on borrowers. Basically saying it's smoke and mirrors, guys. They're saying it doesn't improve their financial condition, other than in a few cases where you have a low income in the present and expect it to grow significantly after a couple of years. So once again, you're placing bets that your income is going to grow significantly by the time the buy down is over, or you're going to be able to refinance, one of those two things. And what if that doesn't happen? That's a big bet to make on your future housing payment. And this is where so many people are getting into trouble. First of all, let me just start off by saying that if you are a buyer today and you're looking to get a mortgage rate buy down, it's not going to be worth it unless you can get that buy down and get a lower price for the property. If you have to pay more for the place like these people did in Oakland in order to get that buy down, it's a bad deal. Don't do it. You're better off just making extra principal payments on your mortgage. You're better off getting the place at a lower purchase price, and I'll tell you why. If you decide to pay the higher purchase price when you're in the transaction, you still have to pass an appraisal, guys. If the appraisal doesn't come in, then the deal might fall through, or you might be forced to bring more money out of your pocket anyways in order to compensate for the higher purchase price. So whatever you're getting in the buy down is not going to be worth this potential problem to come up if you still want to actually close if the property doesn't appraise. Another big problem, the more you pay for a property, the higher your property taxes will be. That's a guarantee. It's always in your favor to pay less for the property than more, not just for your wallet, but for your future expenses as well, because your assessed value on the property is going to be higher if you decide to pay more for it. Here's another big reason. If a price increase raises your loan to value ratio above 80%, you're going to have to pay private mortgage insurance, okay? And probably a higher interest rate if that's the case. So that definitely makes the buy down not worth it. And there's actual data on this as well. According to Freddie Mac, homeowners who got temporary buy downs received note rates that were about 0.15 percentage points higher on average than people who didn't get a rate buy down. So really, these mortgage rate buy downs are being used as bait to get people in, especially with home builders. And the only other way that this might make sense, besides getting a lower price plus the buy down, is if you can get a permanent buy down. If you can get a seller to actually pay points against your mortgage interest rate and pay those points on your behalf and permanently lower your mortgage interest rate throughout the entire life of your loan, that might be something worth considering as well. But how many builders or homeowners are willing to do that right now? I don't know, but it's something to ask and find out. So please, guys, if you're going to be buying today, make sure you have the budget, okay? Make sure you have the budget for repairs. It's going to be one of your three main expenses besides your property taxes and insurance. It's going to be repairs. And forget about the mortgage, but of course, you know you're going to have to pay that. But those three things are going to be the big three. That's going to be the cost of ownership. Don't fall for the mortgage rate buy down as a big incentive to buy. Ask your lender to run different scenarios and show you how much you're going to save by getting that mortgage rate buy down. Do your own calculations as well. Find out how much faster you could pay off the house if you were to put extra money towards the principal payment each month. All these different things that you can actually do to save you money on interest that don't require you getting this mortgage rate buy down, which is basically smoke and mirrors, like they said. You should only be taking the buy down in addition to other incentives or savings, not as the only incentive in lieu of everything else. And by the way, if you are someone who's looking to buy today, I have a free service available to you where I can get you set up with a real estate agent in your area at no cost to you. That benefits you and it benefits the channel. So if you use it, it really helps out and I appreciate it. Now the next thing, guys, is Airbnb. New York right now is basically doing everything they can to sort of ban Airbnb and short-term rentals in general. It's not just Airbnb, just short-term rentals. Starting September 5th, New York will be enforcing short-term rental rules more aggressively, and you already have a bunch of people pulling their listings off of Airbnb because of this upcoming deadline. So moving forward, if you want to have a short-term rental in New York, now you're going to have a license to do so. You need to register with the city to continue providing short-term rental services, and you can only do this if your short-term rental meets several requirements. And here's the big one that really is going to be the deal breaker for most people. You cannot rent out your entire apartment or home even if you own it. Hosts must be present during their guests' short-term stays. So in other words, they're saying you can't rent the whole place out like you normally would on Airbnb. You have to be there, guys. So you can only provide one of these listings where you basically rent out a bedroom or maybe a portion of the property while you're still living there. And I can tell you, as someone who has used Airbnb several times, and even on this trip, I wouldn't stay in a place like that, because why am I going to stay in some stranger's house? I don't even know these people. It's going to be extremely uncomfortable and just weird, you know? And I want my privacy. I don't want to stay with you. So if that were the only option in an area that I would be looking in, I definitely wouldn't be renting an Airbnb. And this is another big warning for real estate investors, especially people who bought over the past few years during the pandemic, thinking that they were going to cash in and make a fortune off of Airbnb, because this is a big curveball for people that got into this business model, guys, because you're basically also placing a bet that the area that you buy a short-term rental in is going to continue allowing it to happen. And more places are pretty much trying to do everything they can to ban it. You already have places like Dallas, Texas, they've banned it. Philadelphia, they banned it. Okay, New Orleans, they have restrictions on short-term rentals. And those are big cities, big major areas where doing Airbnb is next to impossible now, or it's so restricted in a way that it no longer makes sense to do, like what New York is doing. I understand that not everybody does this for a profit either. Some people just do it to pick up the extra costs of leaving a place empty, especially if you travel a lot for work, right? There's an example of a guy who lives in New York that does this. He says that most of his visitors are families who can't afford multiple hotel rooms, and this means that with these new regulations, he's not going to be able to list his apartment and will likely lose half his current income. He says he might even need to move out of the apartment because he might not be able to afford the place without that extra income. So people who are also house hacking in order to try to make ends meet and pay for their rent also could be affected by this. And I have a feeling that this is going to have a huge shakeup in the market, guys. And this is just the beginning. These are just local metros that are putting these bans or big regulations in place. What happens when this starts happening all over the place? Because one thing that's for sure going on right now is people are sick and tired of having no inventory on the housing market. And if a new measure comes up on a local ballot about banning Airbnb in order to hopefully release more housing into the wild, don't you think most people are going to be pretty happy to vote yes on that because they can't afford a house? So this is the future that I see coming from this because of the housing affordability crisis that we're in right now. And this is going to have a huge impact on the amount of available Airbnbs in New York City, because they estimate there's about 10,800 illegal short-term rentals citywide. And they're saying that about 5,300 existing reservations after September 5th will be affected in the first week alone once this new law goes into place. And basically this new law prohibits the booking platforms, not just Airbnb, but also Booking.com, Vrbo, these other places, they can't even take the payment, guys. So they're banning them from processing payments for unregistered transactions. So if someone just tries to list a fly-by-night Airbnb on one of these websites and they don't have the proper credentials, then they're not allowed to process the payment, essentially making it so that person can't do short-term rentals. The city of New York is trying to make it impossible for people to be able to register these new short-term rentals because they're short on staff, just like everybody else, of course. And they say that as of July 25th this year, the city received about 1,632 host registrations and approved only 141 of them. And Airbnb is saying that the city's sending a clear message to millions of potential visitors who will now have fewer accommodation options when they visit New York City that you are not welcome. Now, I don't think that's the message they're trying to send. I think what they're trying to do is get a hold of this housing affordability crisis, and obviously that's one of the most expensive places in the country to live. And by putting these strict rules and bans in place, I think their theory is that more of this inventory that's locked up in Airbnb right now will come to the market. And that'll be a good experiment to watch and see how this plays out and see if that actually happens, guys, because if it does, then that'll be a good preview of what could happen all over the country if more places were to go ahead and do this. Now, I'm not sitting here saying that they should ban Airbnb. I'm not saying that that's the right approach. I'm just telling you that's what they're doing. Even my own personal opinion on this is like, I understand the problem. I understand how Airbnbs definitely remove inventory from the housing market. I think that's actually true, guys, because for example, I'm staying in an Airbnb right now, and this place is not on the market for rent, and the owners are not selling it. And these people basically have this place as a second home now to come and use it whenever they feel like it, and now they live in Hawaii. So clearly they're doing okay. They're making money if they're able to live here and then also have a place in Hawaii. And having this Airbnb kind of allows them to have that lifestyle, right? But if they weren't allowed to do Airbnb here, then they would be forced to either rent it out at the fair market rate to a long-term tenant, or if they wanted to have a second home here and can't afford to swing both places, they would be forced to sell it. So I do think that making it hard for people to do Airbnb, or impossible in some cases, can have an effect on future inventory, because just looking at that situation. But at the same time, I'll also say that it would suck not having Airbnb, because I don't want to stay in a hotel, guys. I'm here for a month and a half in Northern California. In case you don't know this area, there's not that many nice hotels around here. And you know, it's not the same. You don't have all the amenities you have in a regular house. Like this place has a deck, it has a little yard, it has a view, it has a place to park. I don't have a bunch of neighbors, you know, all things that you don't really get with a hotel. And I actually paid more to stay in this Airbnb than I would have had to pay to stay in a hotel in the area, but I knew I didn't want to basically live in a hotel room for a month and a half. So those are the compromises that you have to make if you're staying in a hotel. The other thing is too, in some of my older videos, I used to give people the advice that, hey, listen, if you want to make a move to an area, if I was to move here, I'm looking at what is it like to live in the neighborhood, okay? And that's something you can't experience when you stay in a hotel. You can only experience that when you stay in a home nearby and stay in an Airbnb. Actually staying in the neighborhood, staying in someone's house, you actually meet the neighbors. I've met both neighbors already on both sides of the house I'm staying at. Both neighbors next door to each other, both very nice people. And that's an experience that you just wouldn't get in a hotel. And so there is value in having Airbnb, right? And also you could say that the government getting involved in this is encroaching too far into people's personal property rights and what they're allowed to do with their property. So like I said, I'm not really for or against them doing this. I'm just saying that I think they might be onto something in terms of how much inventory this could potentially release back into the wild if more places were to do this. And we should be all eyes on New York now after this and see how many people give up. But I will say that New York probably needs to really enforce this and really crack down if they want to have any chance of this working, because they say that unregistered short-term rentals won't be punished, but the hosts face fines ranging from $100 to $5,000 depending on the violation. So if they really want it to work, they're going to have to make the violations very steep. That's what Miami Beach does. For unregistered short-term rentals, if you do it illegally in certain areas where I live in Miami Beach, they will hit you guys. The fine used to be $20,000 per offense. I think now, after they got sued, it's like $10,000 per offense. But still, that's a huge fine to pay if you get caught doing an illegal short-term rental. That will just wipe out all your profit. Anyhow, I hope you enjoyed seeing where Robin Williams used to live. It's definitely a nice and quiet neighborhood. I know I sure did. And if you guys enjoyed this video, please subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.